Hello everyone, thanks for checking out my video. S&P 500 ended last week with second weekly loss. Strong economic reports and sticky inflation have shifted investors' sentiment from bullish to bearish. To make things worse, Fed officials came out to spook the stock market by suggesting a possible 50 basis point rate hike. Are bears back in control? Should we be concerned about the latest pullback? I will be covering them all in this video, so watch on to find out more. Stocks movement were mixed last week as sticky high inflation and a potential high interest rate hike continued to weigh on investor sentiment. It was an eventful week, which can be summarized into 4 segments. Firstly, on Tuesday, CPI figure was reported as 6.4%, which is higher than the market expectation of 6.2%. But the market rallied anyway, likely because at 6.4%, it is lower than previous month of 6.5%. To add on, this inflation number has declined for 7 consecutive months. Next, jobless claims came in at 194,000, lower than what economists have expected, which is 200,000. This is a sign that the labour market is still tight and strong. Thirdly, January's retail sales data showed a sharp jump. These 2 reports are signs that the US economy is still strong despite Fed's attempt to curb growth and bring down inflation through the various rate hikes. Finally, we have the Producer Price Index, aka PPI, which is an inflation matrix that tracks wholesale prices. It came in hot as well. It rose by 0.7%, more than economists' expectations. So all this that I have just mentioned are pointing towards the fact that inflation is likely to continue to be sticky and stubborn. And as a result, Fed may be convinced to keep increasing interest rates, and obviously, that is bad for the stock market. In fact, several Fed officials have already came out to share their hawkish stance. For instance, one said that there is a long way to go before the central bank reaches its target of 2% inflation. 2 other Fed officials commented that they are supportive of larger rate hikes in March amid the sticky inflation. And so, on the back of those comments, investors will start to price in a growing probability that the Fed may choose to move by more than 25 basis points at the next meeting in March. Anyway, the next FOMC meeting is about 1 month from now, on 21st and 22nd March, so that's still some time from now. Based on the current expectation, the market is anticipating a 25 basis point rate hikes in March and May. But just to share with everyone, economists at Bank of America have cautioned that the Fed might have to hike further beyond March and May if inflation, job growth, and consumer demand refuse to soften. Anyway, for the week ahead, it is a short one, with US stock market closing on Monday in observance of the President's Day holiday. The highlight for the upcoming week will be Nvidia's earnings, which are due on Wednesday night. Analysts are expecting Nvidia earnings to rebound. Investors will likely be curious on what Nvidia has to say about the recent rave about artificial intelligence. Looking at the broader market, 2023's rally still appears to be in the midst of a normal pullback. In fact, I have shared about a meaningful pullback a few weeks ago, and now we had it for the last 2 weeks. Despite that, most market leaders and indices didn't suffer major damage. In the next 1 or 2 weeks, we will have to see if their critical support levels can hold. If yes, then it will be good news for the bulls. So now let's move on to the technical segment. Alright, as usual, we will start things off with SPY, which tracks the broader US market. First up, let's talk about the potential bullish thesis. On the weekly chart, the bullish head and shoulder pattern is still forming quite well, but we can expect some resistance at around 420's range. SPY needs to break and close above this range decisively before we can unlock more upside. When that happens, the upside could be massive, and we are looking at 450's range. But then, it's an uphill task in my opinion right now. So let's take one step at a time. Let's aim for 420's range first. Moving over to the daily chart, last week, I shared that it appears that a bull flag is forming on the daily chart. Update for this week, bull flag is still intact. No breakout, no waterfall. For SPY to be bullish, it needs to break out of this bull flag, and then we can charge towards 423 resistance level. But before that, yes, we need to reclaim that 408 critical level first. On the bears camp, there is still a lot of work to do. Well, we did close below this key level of 408, thus turning it to resistance level. But as long as SPY stays above the downtrend line and the 200 moving average, which is at 390, I personally think that bulls are still in control. Below that, we still have a strong support at 385. Anyway, other than breaking below 408, the other thing that bears can cheer about is that MACD continued its bearish cross down last week, and it seems like we still have some room to go down if sellers start stepping in early this week. Okay, now let's check out Apple. Just like SPY, Apple's bull flag is still intact, but no breakout or any sort yet. In fact, it did try to break out a little, but came back down again. That is actually a little bearish in my opinion, as it is showing a bit of weakness. If the weakness continues this week, we could test the support level of 148. And when that happens, it will increase the probability of us filling that gap between 146 and 147. This area is a strong support as that is where the 200 moving average sits as well, at 147. For bulls, you would want this to hold. If Apple prints 2 or more candles below this level, I think we could slide to 140 to 143 range. Again, personally, I am hoping to pick up more shares at 130's range. Not sure if it will come, but we shall see. On the bullish side, very simple, Apple has to break out of this bull flag pattern. Then the bull can be unleashed and charged towards 163. From there, if FOMO buyers step in, we could potentially fly towards 173, where I believe it is a profit-taking zone. In my opinion, I think it will be tough for bullish thesis to pan out at the moment without any retracement. Because if you take a step back and zoom out of the chart, again I would like to bring your attention to June to August 2022 period, when Apple flew up massively and came tumbling down. Not saying the exact same thing will happen, but some form of meaningful pullback would be necessary purely from technical perspective. Just to also highlight, the MACD is a little extended. In the last few times it happened, Apple retraced quite a fair bit. Again, nothing is guaranteed. I'm just presenting what I see on the chart. Feel free to extrapolate what you deem fit. Moving over to Tesla, last week I shared that there were a shooting star pattern on the weekly chart and a bearish abandoned baby pattern candlestick on the daily chart. So Tesla only dipped on Monday to slightly below 190, and then it went back up to above 200. By sharing this, I thought to be transparent that though TA can offer you some form of probability that something can pan out, but it does not always happen. So this is one good example. I am not gonna run away from that. Anyway, Tesla is looking strong right now, and we don't know how long this bull run can sustain. At a glance, I would say the first profit-taking zone is at around 220's range, where there is this mini consolidation zone. This area will pose as a heavy resistance, and that is where the 200 moving average is as well, at 223. Therefore, it's almost like a double resistance at this level. Above this, the next resistance is 237. And if Tesla can break above 237, wow, there is little resistance all the way to 250's range. On the downside, 200 should offer some form of psychological support. In fact, Tesla has been flirting around this area last week. If Tesla starts closing below 200 for about 2 or 3 days, then bears will potentially bring it down to 185 and even 170. A huge support will come in only at around 150's range where the gap is, as well as where the current 50 moving average sits. If Tesla ever comes back to this area, I will be excited to pick up more shares. Anyway, something to highlight, MACD seems to want to have a bearish cross, but then buyers keep stepping in, hence the bearish cross has not taken place yet. So watch this carefully. When buyers get exhausted and sellers start taking profits, then the MACD may cross downwards, and it can be quite aggressive in my opinion. And the 20 to 30 points downside should not surprise anyone, and that will put us in 180's range. Okay, now let's move on to Google. Google has been trading sideways for the longest time, between the range of about 85 to 105. This is also why I love to trade options for Google. Anyway, Google has fallen below the 200 moving average and the psychological level of 100. This means both will now act as a resistance as it tries to climb back up. In fact, if you realize, Google has been below 100 since October 2022, and it only popped above this level on 2 occasions, and each time it didn't last more than 4 trading days. Again, if you know how to trade options, you could profit from the stock movement within a tight range. On the downside, watch out for 90 as the first support level. If that does not hold, I would think the chance of us filling that small little gap at 88 to 89 is high, and we could retest the recent bottom of about 85. To add on, so far the range of 85 to 87 has been holding up quite well, and that is the reason why I sold a cash secure put contract last week with 87 as the strike price, which I will elaborate in the next segment. Okay, for those who knows options and curious about my options trades, this segment should interest you. In my last video, I shared that I sold a few covered calls, a bearish move, in January this year when the market was in euphoria mode. With yet another pullback last week, those trades remain in the profit territory. With the second pullback week in a row, I saw some opportunity to sell options put contracts, which is a slight bullish move. So what happened was that last Thursday, when the market reacted negatively to the various strong economic reports and hawkish Fed speeches, I took the opportunity to sell two put contracts, one on Tesla and one on Google. Again, I shall emphasize that this is a slight bullish move. It is not a very bullish move. There is a difference, okay? For Tesla, the reason is simple. I am just riding this upward momentum. Remember what I always preach? Ride the trend, or trade the chart and not what you think. This is what I am doing right now. And if you take a look at last Friday's session, one day after I sold the put contract, when almost all mega cap stocks were down, Tesla was up 3.1%. As shared earlier, the bull flag seems to be forming well on Tesla, and I think this momentum could potentially bring us to the next profit-taking zone and 200 moving average at 222 to 223 level. Even if it doesn't, as long as Tesla floats around the current range till 24th March, my trade will profit. To add on, I can also close my trade anytime before 24th March if the profit is good. So do read about options trading if you are not sure what I am talking about. As for Google, I have also shared in my last video, check it out if you haven't watched it. Basically, I was watching it closely because investors had overreacted to Google's AI blooper, which triggered a temporary sell-off. And then last Tuesday, there was a bullish dragonfly candlestick on its daily chart. It was followed by a nice green candle the very next day. With that, when it pulls back on Thursday, I quickly entered to sell a cash secure put option with 87 strike price. Why 87? That's because there is a strong support at around 86 to 87 range. Okay, these are just my train of thoughts behind why I sold those put options. If you like this segment, do comment below, but if no one is keen, I may remove it in future segments, as it does take some time to recall or jot down why I made the trades last week. Meanwhile, two quick disclaimers. Those put options are cash secured puts, meaning to say I am prepared to hold 100 shares of them for each put contract that I sold. In short, I have cash on standby to buy those stocks if I get assigned with the contract. Finally, please do not follow my trades blindly, as you cannot follow me in real life when I open or close those trades. Some quick end thoughts. Overall, from a technical perspective, the pullback still looks healthy at the moment. Even when the major indices lost their early week gains last week, most of them still held on to their key support levels. Companies like Apple and Nvidia are still performing decently, while Tesla continued its huge bull run. That said, whether the current pullback could last for an extended period or could it turn into a more damaging retreat, it remains to be seen. Personally, I think the market should hold up at least till the next FOMC meeting, if there isn't any surprise from the Fed now. Macro-wise, recent economic data and reports have driven concerns that the central bank will maintain its hawkish stance, drive interest rates higher and keep them there longer than expected. Meanwhile, something interesting to share with the viewers, it seems like individual investors have been stepping up stocks at the fastest pace since the start of the year. Over the past month, retail investors funneled an average of $1.51 billion each day into US stocks, the highest amount ever recorded, according to data from research firm VenderTrack. To add on to that, strategies at VenderTrack has said in a note that with recent surveys showing institutional investors community remain broadly bearish on stocks, it would be unwise to underestimate the importance of the retail cohort. For this, some may suggest that retail's buying power should not be underestimated. But for me, I see it from another angle, and that is, I wouldn't want to follow the FOMO crowd. Okay, more interesting stats from the report. Tesla remained the favorite among retail investors, with inflows totaling $9.7 billion year to date. The SPY ETF, which tracks the benchmark S&P 500, has been the second most popular purchase by retail investors this year, with retail flows totaling $3.6 billion. And then we have Amazon, Apple, and Nvidia rounded out the top 5, receiving $1.8, $1.7, and $1.4 billion in inflows this year, respectively. Together with Tesla, all these individual names were up from 20% to almost 100% this year. Again, I'm not sure about you, this amount of retail inflows is actually one of the reasons why I have been cautious about this year's rally. I would prefer following the smart money, aka the institutions, rather than the dumb money, aka the retail investors. And yes, sadly, we are labelled as the dumb investors. Okay, have you been chasing the 2023's rally? Let me know in the comments section below. If you can, do also help me tap the like and subscribe buttons if you have not done so. Thank you.